In a first interaction with Ticker TV, we have Sunil Subramaniam sir, MD and CEO of Sundaram Mutual Fund. Sir, welcome on Ticker TV.
Good morning, and Manoj, and all the best to Ticker TV. I think a very good smart option for a new smart world.
Thank you so much, sir. And we are. It's a pleasure to have you on Ticker TV as well, sir. So we talk about Indian markets and concerns on the Indian markets from here on. RBI has recently tweaked its guidelines for the banks. And what do you think, sir, will be the implication on the sectors going forward?
We think that this is a very good move from a fact that it is a fact that the Indian banking system has carried a lot of excesses not only in terms of NPA but in terms of excess lending, because a lot of excess capacity has been created in the period of 2007 to 12. Just to give you a little bit of historical context to this, 2003 to 7 was the boom time for the world and India.
Right.
And because of the fast rising demand, a lot of private sector had set out into capacity expansion as well as into new products.
Perfect.
For which bank financing was naturally the primary route. But I think what happened is that the global Lehman Brothers crisis and financial crisis, subprime crisis, meant that economic growth collapsed, and in the result of this, a lot of the capacity didn't get utilized. New products which were initially did not take off, naturally leading to a hangover on the banking system of the NPAs. So I think while RBI has been doing step by step 525 strategic restructuring, they have announced a lot of steps to clean up the NPA. What they are finding out, I think, gradually as they peel the onion, is that a lot of these are fundamental issues, and the early warning systems in the banks which should have functioned in terms of pulling them seem not working. I think so RBI is gradually, what they have been doing is they have been trying out different methodology, and the latest one which they announced is where I think it's a real-time NPA monitoring.
Exactly.
Which is, identifying the early warning signals, the first sign of trouble. That's the need of the hour. So I think from a fact that a healthy banking sector is absolutely critical for the capital markets, right? Anything which is done, in the short term there may be pain in that some bank may report NPAs higher than normal. Exactly. But I think once the poison pill is swallowed, and RBI I think has a separate definite plan to either merge banks, create a bad bank, or through this NCLT process sell off these kind of toxic assets to other.
So what is the implication in terms of on the PSU banks versus the private sector theme or the NBFCs going forward?
See, what we have found, if you look at over the last 1 year, RBI has this methodology of doing inspection, and quite often they have come up with surprises on adding to the NPA that the banks have been providing. And there has been some private sector banks which have come and some public sector banks. So I would say that this is not, essentially this is the corporate banking problem. So rather than look at it as a private versus PSU, I would say retail versus corporate. I think retail, still the loan quality is good, it's spread across large number of borrowers. The corporate lenders, whether from private sector or corporate sector, are the ones which still have some pain because of the historic NPAs. And I think the actions taken, RBI is not just focusing only on the bank cleanup, but they're also going down in terms of, the capital infusion, which has already happened. Means that all the toxicity of the past, I think, has been cleaned up.
Perfect.
So I think I would view this as a good news for the long term.
So investors need not worry about it.
No, absolutely.
Moving on the macroeconomic front, if you see that inflation rising is a concern, and rates is also a concern from here on, and a fiscal deficit front, what do you think, sir, will be the entire scenario moving on for the Indian economic perspective?
Okay, there are 2-3 things to bear in mind. I think that while the fiscal deficit has gone a little bit out of what was promised in the FRBM, I think you got to remember 2 things. First is that we are a fast growing economy. So I think, and as far as my personal view is that an excessive focus on fiscal deficit at the cost of hurting growth is not welcome. One. The point is, what is the right fiscal deficit? Right? I think of fiscal deficit, the quality of the deficit is more important than the quantity of the deficit. What do I mean? Is that when you're taking fiscal deficit, is government borrowing more. Where is he using the money? Is he giving it away through NREGA payouts, through bank loan waivers, through subsidies to the food and fertilizer sector or oil, or is he putting into infrastructure, into roads, into rural electrification, into housing? So the good quality. So that why I'm saying this is the expenditure goes on consumption expenditure like giveaways creates a somewhat money multiplier effect.
Right.
But what goes into infrastructure creates a capital multiplier effect.
Exactly.
Capital multiplier effect in the long run has the ability to push the GDP up to the next level. One. Second, create employment generation.
Right.
So I think we should be tolerant of a slightly higher fiscal deficit, because I think this government is using it in the right way in terms of roads, railways, affordable housing and infrastructure.
When you talk about US bond yields, they are inching towards 3%, and oil is again, going back to 65. Your quick comment on that?
My quick comment is that I'm very contra to the world view on this.
Okay.
According to me, the inflation and the oil price rise are indicating a revival of demand in America.
Fantastic.
And the revival of demand in America is critical for India's growth, because today India has surplus of young people who need to be put to work.
Exactly.
And unfortunately, our per capita income is still at such a level that we can't buy what we can produce.
Perfect.
So we need America to buy what we produce, and I think a growth sign. So inflation, crude oil rising because of the demand in the US is a welcome sign from an Indian economy perspective.
So, we're talking about markets. Markets post-budget, they have sort of seen a volatile sessions, and concerns over Fed rate hike is already there, as you're talking about. So what do you think, sir? What will be the outlook on markets going forward, and what's your advice to investors?
I think the markets which led to a correction were partly, one, a sympathetic coupling with the fact that Dow Jones corrected because of the rate inflation coming higher than anticipated, employment being higher than anticipated. So there was a sympathetic correction. Second is the LTCG had also, tax on LTCG had led to a little bit of sentiment impact. And I think what it's done is like a pressure cooker letting off steam. I think valuations had run up in the most recent past. We're expecting a very strong earnings growth revival.
Right.
The earnings growth revival is happening, but I think valuations had shot up a little bit, and I think this escape valve which has happened has cooled down the thing, because ultimately, fundamentally, the signal that the world economy is recovering
Perfect.
means that the Indian economic outlook is good. So markets will follow the economic.
You are talking about fundamentals. Fundamentals for the earnings are also improving. We are seeing earnings a recovery. It's a 6-quarter high for
Absolutely.
the Nifty companies you're talking about.
Yes.
What do you have to say?
No, I think this recovery is on the par, because bear in mind that the recovery is in the back of two of the most significant reforms which hurt the GDP growth, is demonetization and GST. So I think both these are fundamentally something which have altered the dynamic from a cash-based system to a banking check-based system, and from a paying multiple taxes to single window tax. So which means that the unorganized to organized sector is what has got her. And once it goes to organized sector, it means higher taxation in income.
Two quick questions.
Yeah.
What's your take on the underperforming sector?
The underperforming sector, I would say today, for me, the single biggest one is the pharma sector, because it's not only facing regulatory challenges across the world, whether it's domestic pricing, because pricing is regulated. The second is that the cost of pharma, this is, I think, coming under a bit of concern, and US is also acting on that. So I would say today, of all the sectors, the ones that we are least bullish on would be pharma.
And you're bullish on?
We are very bullish on the infra play.
Perfect.
Right? If I have 2 more minutes to explain why infra, because the fact of the matter is today, as I explained, we are going through this phase where Modi, when he came to power, was accompanied by a drop in oil price.
Right.
Indian government got about 65,000 crores of additional income every year. He did not pass on anything to the layman in terms of petrol prices, but all of it was plowed into infrastructure. Right? So that infrastructure, ultimately, if you see the tenders and the awards, have shown a sharp 6-year high in terms of awards and tenders, is leading to private sector executing those orders. But that's just the beginning of the capex cycle.
Right.
The next one is, as demand is picking up, thanks to consumption, thanks to the pay commission, thanks to 2 good monsoons, the capacity utilization goes up. There's a lot of short cycle capex happening. Right? Debottlenecking, distribution capex and all of that. The third stage of this will be the fact that when the capacity utilization starts rising to an 80% plus from the 70% levels today, private sector will start planning for new capacity.
Right.
Takes 3 to 4 years to build capacity, so the process will start in, let's say, 12 to 18 months. So that again will lead to order books for cap good suppliers.
Okay.
And finally, the great push to infrastructure will come when all the FDI, for the last 2 years running, India has been the highest FDI announcement in the world, is inward FDI for India. right? But this has to start execution on the ground. So when an FDI actually comes in a plant sets, whether it's an IKEA or a Tesla or iPhone, then you will have land, building, plant, machinery demand. So there are a lot of strong drivers for the infra sector, and I think the valuations are still reasonable if you take it from a price to book rather than a price to earnings.
Perfect. So what's your advice to investors?
My advice to investors is to stay diversified, stay SIP. There are two reasons for why I am saying this is stay diversified in the sense, see, one thing is that is ultimately economic growth, the mid and small cap is better positioned to capture it. But the large cap space is where the consumption, the large banks, those plays are. So you can't put your money all into one basket. I would say a diversified play, and if you ask me in terms of allocation, 25% to large cap, 25-30% to mid cap, and about 10-15% to small cap is one part of the portfolio.
For example, if I am an investor, post budget, if I wanted to invest say maybe 1 lakh rupees in mutual funds. So being an MD and CEO of Sundaram Mutual Fund, what will be your recommendation?
So I would say put 60% of your money in diversified mutual funds, which is, like I said, 20-25% large cap, 20-25% mid cap, and about 10% to small cap. The balance 30%, right? I would say you actually take sectoral mutual fund calls.
All right.
So to me, 2 or 3 sectors stand out here. One is infrastructure.
Right.
There are sectoral funds
Sure.
in infrastructure. Second is banking and financial services.
Sure.
Because banking and financial services is a huge potential. And the third play would be some amount of consumption. Because I think for the next 12 to 18 months, consumption will still be a good driver of the markets.
Thank you so much, sir, for talking to us. And it was a pleasure having you, sir.
Right.
Thank you so much.
Thank you, Manoj. Wish all the best again
Thanks
to
so
take a
much.
tea.